For decades, traders have been glued to their screens, right? Just hunting for those secret shapes and patterns they think can predict the market's next big move. But what if the real secret isn't in the patterns that work, but in the ones that fail? Yeah, that's the surprising truth we're going to dig into today.
And that really is the big question, isn't it? Can these simple shapes on a chart actually predict the future? I mean, we look at these lines, these squiggles, and we're told, hey, that's the hopes and fears of millions of investors, all right there. But is it a real map to making money, or is it something else completely?
Okay, let's take a look at a classic example. This right here, it's called a double bottom. See how the price hits a low point, bounces up, drops back down to that same low, and then bounces again? It creates this perfect little W shape. And for ages, seeing this was like a green light. It meant buy. The thinking was, okay, the sellers are tired out and a big rally is just around the corner.
And really, when you get right down to it, that's all a chart pattern is. It's not some kind of voodoo. It's just a picture of market psychology. Every single peak, every single valley you see on that chart, well, that's just a bunch of human decisions. It's fear, it's greed, it's uncertainty, all playing out right in front of our eyes.
And because everyone believed these patterns captured that human element, they kind of became this secret code. If you could spot a head and shoulders or a bull flag, it felt like you were in on something, like you had this special edge, an inside track on what the market was going to do next. Okay, but here's where the plot thickens. In the markets we have today, these super fast algorithm-driven machines, that old rulebook, it's pretty much getting tossed right out the window. Those secret codes aren't so secret anymore, and worse, they're starting to fall apart.
And listen, this isn't just a tiny little shift. We're talking about a fundamental breakdown. The very patterns that were like the bedrock of technical analysis for decades are suddenly becoming super unreliable. And that's leaving traders who are still playing by the old rules in a really tough spot.
And look, this isn't just a gut feeling I have. The data absolutely backs this up. A top analytics firm, LuxAlgo, they put it pretty bluntly. Some of the most popular patterns out there, they're now failing almost 50% of the time. I mean, that's basically a coin flip. Just imagine betting your hard-earned cash on something that's wrong half the time. It's wild.
I mean, just look at this chart. This is for downward breakouts, a classic sell signal, right? Well, the research shows the failure rate nearly doubled in just one decade. It went from 26% in the 90s all the way up to a staggering 49% in the 2000s. It's just, the game has completely changed.
And it's not an isolated thing either. We're seeing this across the board. Things like pennants, the famous head and shoulders, so many of them have these really high failure rates now. It's almost the new normal. So just blindly following them, yeah, that's riskier than it has ever been.
But what if that failure, what if that's the new signal? This is where it gets really interesting. This is the counterintuitive twist where a lot of modern traders are finding their edge. It's not about spotting the patterns that work anymore. It's about figuring out how to profit from the ones that fail spectacularly.
So let's define what we're talking about here. It's called a busted pattern. And here's what happens. A stock does exactly what the textbook says it's supposed to do, but just for a second. It breaks out, it sucks everybody in who's following the old rules, and then bam, it snaps back and just takes off in the opposite direction.
Let me walk you through how it unfolds. So step 1, you get that initial breakout, the one everyone's expecting. All the old school traders jump on board. Step 2, the move just fizzles out. It stalls, usually after moving less than 10%. People start getting nervous. Step 3, a really sharp reversal hits. And finally, step 4, you get this massive breakout in the opposite direction. And you know what's fueling it? All those traders who are now completely trapped on the wrong side of the trade.
Okay, now this is probably the most incredible part of all the research. A failed pattern can actually be more profitable than a successful one. I'm not kidding. Look at this. A successful triple bottom pattern, on average, it leads to a 37% rise. Pretty good. But a failed triple top, a pattern that was supposed to signal a drop, when that busts, the average rise is 42%. It's even better.
So why on earth is a failed pattern so powerful? Well, the leading theory is that the market just loves to do whatever will confound the most people. When a move that everybody is expecting suddenly fails, it catches a ton of traders completely off guard. They all panic and rush for the exits at the same time, and that creates this sort of vacuum. And the price just snaps back to fill it, creating a really fast, really powerful move the other way.
And it's not just human traders who are noticing this shift in the market's behavior. We're now teaching artificial intelligence to spot these very same patterns.
And that leads to a really big question. Can a machine learn how to play and win this new game?
So what researchers are doing is basically feeding these AI models hundreds of thousands of tiny little snapshots of charts, kind of like the ones you're seeing here. They're literally teaching the machine to see the visual clues of, say, a double bottom or a bear flag, the same way a human trader would. The difference? The AI can do it at a scale and speed that we just can't even comprehend.
And some of these AI models are getting scary good at it. There's a specific type called an LSTM network. It's basically designed to understand sequences over time, which is perfect for this, and it can identify these patterns with up to 97% accuracy. So just spotting the shapes? Yeah, they're incredible at it.
But, and this is a really important but, AI is not a magic solution. The very same research found that an AI model that was trained perfectly on one stock's history, well, it did a terrible job when they tried to use it on a different stock. It just goes to show that every little part of the market has its own unique personality, its own quirks, and even a super advanced AI has a hard time figuring that out.
So, what does this all mean for you, for the modern trader? Well, it means the edge has moved. It's not about memorizing a bunch of simple shapes from a textbook anymore. It's about understanding the much deeper, more complex game that's being played.
So, let's wrap this up. What's the takeaway here? First, you gotta accept that those classic textbook patterns, they're just not as reliable as they used to be. Second, and this is the big one, you need to start seeing a busted pattern not as a failure but as a huge opportunity, a really powerful signal. It all comes down to understanding the psychology of the crowd and trying to figure out what happens when everyone is expecting the same thing.
Which kind of leaves us with one last question to chew on. In a world where everyone is staring at the same charts, reading the same books, and expecting the same outcome, maybe the real skill, the true modern edge, isn't about following the crowd. Maybe it's about knowing the perfect moment to bet against it.